The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. You're listening to the Telltale's Weekend Update. I'm Ava Cabot.
And I'm Marcus Graham, the Cash Flow Desk.
Quick note, the show is produced entirely with AI tools, and both voices you're hearing are AI generated. Send feedback through the Substack. We're still in the early run of the show. Listener feedback is shaping what we do. This week is a split screen. Nvidia prints Wednesday after the close. The big box retailers print Tuesday through Thursday. Home Depot, Lowe's, Target, Walmart. The AI trade and the tariff trade get tested on the same 3 days. By Friday, the market knows which side delivered. On Wednesday's main show, Hunt, Jason, and Mike walk through Meta as the most profitable AI application ever built, the answer to whether AI capex actually compounds back into the income statement. This week, the test moves to the picks and shovels side, Nvidia, and the read across to whether the tariff regime is showing up at the cash register. On page 8 of the memo this week, Home Depot Tuesday morning, Lowe's and Target Wednesday before the open, Walmart Thursday. 4 big box prints, 3 days, 1 customer. The customer is the same. Middle America, mortgage burdened, tariff exposed. The wound isn't. Home Depot is the only one of the 4 where the stock has already done the work. 25% off the 52-week high going into the print. Reports Tuesday at 9 Eastern, 342 consensus on $41.5 billion. Truist cut its price target from $424 to $394 3 days ago, and management already told everyone they will source no more than 10% of products from any single foreign country. That's the tariff hedge, on the record before the print. Lowe's is the rare print where 2 top-tier analysts disagree on the same number. Reports Wednesday before the open. $2.96 EPS on $23 billion. Citi upgraded to buy on May 12th, $2.85 target. They cited 4 straight quarters of positive comps. BofA downgraded to neutral on May 5th, $260 target. They cited housing turnover at multi-decade lows. Same company, same week, 2 completely different setups. Target is the only one of the 4 printing into a customer base that left. Reports Wednesday before the open, same morning as Lowe's. Consensus 141 on $24.5 billion. Foot traffic at Target stores is down year over year for 25 of the last 27 weeks since the January DEI announcement. The boycott officially ended in March, with no new diversity commitments, and Ulta Beauty is walking out of the partnership in August after 5 years. Walmart is the only one of the 4 restructuring while expanding. New CEO John Furner cut 1,000 corporate roles this week. Prints Thursday. 65 cents on $175 billion. The ad business is up 50% year over year, and the U.S. e-commerce business posted its first profitable quarter globally. The memo can't anchor Walmart. Trailing 12 free cash flow is negative because of capex. Marcus stays off the name. Marcus. 2 of these are pricing differently than they look. The cash flow take.
Target is the wounded one in the gauntlet, and the memo isn't pricing it as wounded yet. 24 times trailing free cash flow on $3 billion of TTM FCF, 10K confirmed. The market is pricing Target like the foot traffic hole closes on its own. 25 of the last 27 weeks say it doesn't. The gross margin guide Wednesday morning is what tells you which side is closer to right. Home Depot is the cleanest test of the 4. 24 times trailing free cash flow on $16 billion of TTM FCF, 10K confirmed. That's not punitive for the share leader of home improvement. The stock is 25% off the high. Most of that move is housing turnover, not Home Depot losing share. The test Tuesday morning is whether the pro-contractor segment is actually offsetting DIY weakness, or whether management has been packaging hope as a thesis.
2 prints, 2 questions. Whether the foot traffic comes back at Target. Whether the pro-contractor is real at Home Depot. Lowe's settles a disagreement between 2 analysts, and Walmart has to convince anyone watching that cutting jobs is part of the growth story, not in spite of it. Nvidia, Wednesday after the close. This is the most consequential print of the year. Consensus is 174 EPS on $78 billion in revenue, plus or minus 2%. Blackwell B200 and GB200 are sold out through mid-2026 on a backlog described as, quote, insane, 3.6 million units. Hyperscaler capex for 2026 is guided at $725 billion, up 77% year over year. Nvidia takes roughly 90% of the AI accelerator dollar inside that. Now the China complication. On March 5th, Nvidia halted all H200 production for China, about 400,000 units of orders that don't get filled, roughly 30 billion of walked-away revenue. Then this week, Jensen Huang rode Air Force One to Beijing. For context, Trump brought 17 CEOs to China. Only 2 got Air Force One seats, Musk and Huang. Huang secured U.S. export approval for H200 sales to 10 Chinese firms, Alibaba, Tencent, ByteDance, JD.com, opening an estimated $50 billion annual market. And then Beijing told its tech companies to pause orders while the government decides on import approval. And one more. The Rubin platform was announced at CES, 5 times Blackwell on inference, 3.5 times Blackwell on training, 10 times reduction in inference token cost. Production ramps the back half of this year. AWS, Google Cloud, Microsoft, and Oracle are first in line. Marcus, the cash flow take.
Nvidia going into Wednesday night is the only mega cap in the AI stack where the multiple looks reasonable against the cash. 50 times trailing free cash flow on 103 billion of TTM FCF. Fiscal year 26 10K confirmed. Free cash flow grew about 80% year over year. That's the reasonable end of expensive in the AI stack. And reasonable means the math has to keep compounding. The test Wednesday isn't the print, it's whether the Q2 guide carries Rubin pricing.
The China story, net positive or net negative for the next 12 months?
Net positive. And that's the contrarian read. The H200 halt walked away from roughly 30 billion in China revenue, which everyone scored as a loss, but Nvidia carries a $95 billion supply commitment with TSMC. That capacity doesn't sit idle, it reallocates to Vera Rubin. So the trade is walk away from H200 China at H200 margins, redirect TSMC capacity to the highest priced product in the lineup. That's the better margin trade. The export approval and the China pause net to noise. Nvidia keeps the option. The 10 Chinese firms stay in the queue. The downside case is the policy whiplash recurs and the option goes to zero. Probability weighted, I take the trade.
And what changes the read after Wednesday?
The demand side is set. Hyperscaler capex guided up 77% this year. Nvidia at the center of the dollar. The variable is Rubin pricing on the Q2 call. The new platform is 5 times Blackwell on inference. If management talks Rubin pricing on Wednesday, the multiple has room. If they don't, this is as good as the cycle gets, and the next D-rate comes in the back half. The print is consensus minus surprise. The guide is the trade.
So the question Wednesday night isn't whether Nvidia beats, it's whether Rubin shows up in the language. 3 quick ones, a forward week sweep, and we're out. EQT just printed the best quarter in its history. Q1 free cash flow of 1.8 billion exceeded the company's full year 2022 free cash flow. Net debt fell below 5.7 billion. Fitch upgraded EQT to investment grade BBB and Citi upgraded to buy on May 13th. The company is openly marketing itself as the preferred power partner for Appalachian AI data centers through the 2030s. The memo has EQT at 14 times trailing free cash flow at an 8% yield. Natural gas isn't a commodity story this year, it's an AI infrastructure story. EQT is the cleanest expression of it. United Health is the year's biggest comeback so far. Stock hit a 52-week high of 404 on Tuesday, 47% off the March lows. Q1 EPS of 723 beat consensus by 47 cents. The CFO committed $1.5 billion to AI this year and claimed 2-to-1 returns inside 12 months. The memo has United Health at 5 times trailing free cash flow at an 18.5% yield. That yield is what's pricing the DOJ Medicare billing investigation that's still open. The recovery is real. The shadow is also real. Microsoft just got a new bull. Bill Ackman's Pershing Square disclosed a $2.1 billion position this week, accumulated since February, calling Microsoft, quote, a highly compelling valuation. The memo has Microsoft at 135 times trailing free cash flow. Marcus has been calling that not compelling. One of them is wrong. It's a fair fight. The pressure point is free cash flow margin, which compressed from 29% to 19% year over year because of AI capex. Either Azure scales the dollar back into the margin, or Ackman is buying the most expensive software stock of the cycle. Forward week. Costco prints May 28th, Salesforce May 27th, Deer Thursday alongside Walmart. We pick those up next Saturday. 3 quick ones. That's the show. The split screen week starts Tuesday morning. By the time Marcus and I are back next Saturday, the market will have decided which side delivered. Wall Street's consensus on the week: Nvidia beats and retail misses. The risk is that one of those is fully in the tape. Hunt, Jason, and Mike are back Wednesday on episode 2621 with the Nvidia post-mortem, the retail read across, and a deep dive on Google. Subscribe and download this week's cash flow memo at telltales.us. 86 companies across 20 pages. The same memo we anchor every beat on. See you next Saturday. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.